Welcome to our YouTube live, and so this is about the Bank of England. Yesterday we did the Federal Reserve, and what I'm going to do is just go through some of the key points, and we'll talk about the UK economy as well, because I think stepping back and looking at the indicators that the Bank of England is looking at lets us take a kind of broader perspective. And this is an investment channel on PensionCraft, so of course that'll be our focus, and we'll talk about the implications for UK investors at the end as well. So let me just pull up this document which Laura's going to share with me, which is hopefully going to have the your questions in it. So if you do have questions, there'll be questions at the end. If you ask a question and it's a super chat, then you'll get pushed to the front of the queue. If you're one of our supporters on YouTube as well, you'll be pushed to the front of the queue. Tonight I won't choke because I'm not drinking Fanta, I'm drinking Coke Zero. Brilliant. And I've reloaded my treat box for Teddy for when the questions happen. So he was very carefully watching as I did that, so he knows it's done. And so he should thunder up the stairs when it's time. Brilliant. So let's get started. And let me just go through some of the key points. And we'll start with this, and here we are. Good. So I'll make myself small on the right hand side here. And so this is the kind of the headline, right? So the Monetary Policy Committee voted by a majority of 5-4, so only 9 members compared to the 19 for the FOMC in the US. And it was a pretty close call, 5-4, it could have gone either way. And the decision was to keep rates as they are at 5.25%. So you could almost hear all of the estate agents in the UK breathing a sigh of relief when they said that they weren't going to raise interest rates as some people had expected. So 5.25 still pretty high, and we have come a long way, and we'll see that in a moment, but we have tightened a lot. So kind of like the Federal Reserve, they've come a long way. It looks pretty tight now, monetary policy. The question is whether it's tight enough to get inflation down, and that remains to be seen. But pretty close vote, and that was surprising, I think. Andrew Bailey did a tweet. Of course, they don't have a monetary policy press conference unless there's a monetary policy report that comes out. This time there wasn't a report, so we didn't get the press conference, which I think is kind of stupid. Maybe they should think about doing these press conferences every time they change policy. It's not like it's not important, right? So I think they really should do these more regularly. Anyway, here's Andrew Bailey, dragged himself out of Greg's, and he says that this is the first time we've held rates in almost 2 years, because it has been a pretty aggressive period for tightening. And he also makes a point that inflation's fallen quite a lot recently, and we'll see that in a moment as well. So I think the communication from the Bank of England, not great. That's a problem. If we look at the bank rate, that's the policy rate from the Bank of England, going back to 1694 when it was founded, you can see that now we are pretty much in line with the average, the median rate since 1694. And the kind of dashed line here, kind of more recently, that's since 1900. Again, that's at around 5%. So 5% is the kind of normal rate. This is nothing particularly tight in terms of monetary policy. It's just compared to this weird period of zero interest rates that we had recently, lower than it's ever been, in fact. It only looks tight relative to that. So this is the new normal. And it's also the old normal that we had for about 4 centuries. So if we look at the more recent policy rate changes, I've marked on here the biggies. So you can see the 50 basis point increases. Usually it goes in 0.25% steps. These were the biggies, so 50, 50, 75, 50, 50, 50. And then most recently, you can hardly see it on the graph, it kind of flatlines because they didn't raise rates this time around. So very aggressive increases until we got to this level. And it does look like we are approaching the end of the rate hiking cycle in the UK. And for many people, that must come as a relief, particularly if you borrow money via a mortgage. That's what most people's largest debts are. So it does look like the end of the cycle. But another point is that we'll see later on, it might not be the end of the cycle after all. If we look at what markets expect, and usually what I do here is I show the overnight interest swaps market. And unfortunately, I don't have access to that via a tweet because Ed Conway didn't tweet it this time. Ed, sort yourself out. He was talking about his book, very good book on commodities. But still, I didn't manage to find it on a tweet. But we did find it in the FT. And you can see that the expectations changed due to the kind of lower inflation print that we saw very recently a few days ago. So markets expect, instead of where they were in August the 3rd, you can see that the peak rate, which they expect for this cycle, has lowered a little bit as of September the 14th. So that was about 5 days ago. Wage growth, however, is still higher than the Bank of England expects. So that's not such good news, because higher wage growth, of course, means services inflation will stay high, and that could be a problem when it comes to UK inflation, because services is a really large component of many of the components in UK inflation. So high and sticky inflation. This is the problem that the Bank of England is facing right now. Inflation being high and sticky, and it's still high. It's not as high as it was, it has to be said, but we're still looking at core inflation. That's the yellow line, and this is what central banks focus on. That's still at 6.2%. It has fallen a bit over the course of the last month, and this is a year-on-year change, of course. Headline inflation did fall. There's a slight inflection upwards here. In the US, it actually ticked upwards to 3.4% for the latest number because of high gasoline prices. In the UK, rather than falling fast, disinflation that's called, it doesn't mean prices are falling, it just means they're rising more slowly. The disinflation in the UK were just a little bit less than expected. So yeah, energy clearly is pushing things upwards again, which is worrying, and we'll talk about that at the end as well. But for core inflation, which is what the central bank looks at, then it's pretty hard to see a substantial fall. There was a slight fall over the last month, but still more than expected, but still sticky and high. Still 3 times what the Bank of England, at least 3 times what the Bank of England wants it to be. Now, if we look at the contributions to that inflation number, so if we look at the 12-month rate, break it down into its components, you can see how important food is at the moment. Food inflation is still running at something like 13.6%. For the poorest households, this is a real problem, because for them, food composes a larger proportion of their weekly spend in the household. And when food inflation is 13%, it's been at 10% or higher for over a year now, food inflation. And that's going to be a real problem for many households. So for the poorest people in the UK, this has got to be solved. Otherwise, there's going to be untold pain for those households. But you can see that food and non-alcoholic beverages is now the biggest contributor to the 12-month rate. Restaurants and hotels as well, because they're having to pass through higher energy costs and higher food costs because they have to serve food and drink. Alcohol prices also have increased quite a bit, and recreation and culture also. Housing and household services is indirectly due to energy. Transport, interestingly, year on year is now in negative territory. It's the only component which is negative. And what I'd expect to see over time is that the base effects, when you're comparing things year on year, more of these components will go into negative territory. If we look at just the latest month and look at what changed in the CPI components from July to August, this lets us see much more short-term changes in the individual components of the inflation number. Transport is now ticking up a lot, and the reason for that is we've seen energy prices start to rise again, and this is because of production cuts from Saudi Arabia and potentially Russia too, and they're talking about getting oil back up to 100. I made a video about that recently, and that could be a problem because we could get a secondary spike in inflation globally, and that could feed through, if it stays elevated, to other components of inflation because of indirect effects due to transportation costs. It could spread out wider into other components. Half of the components, it has to be said, are now in negative territory. So restaurants, food, furniture, recreation and culture, all of those on the very short-term horizon have started to tick downwards, which is a very welcome relief, particularly food, for the reasons I said. If we compare the UK with the rest of the world, for the developed markets anyway, the UK was clearly the highest for a long period of time. However, what seems to have happened is that it's kind of got closer to the other developed markets. It's still the highest amongst these countries for which the ONS does the comparison, but it's still slightly higher than Germany and above the European average. Oh, there's Teddy. He's obviously worked out. Ted. Yes. It's obviously slightly higher than Europe and quite a bit higher than France, and well above the US if you use the hiccup measure, which is the comparable measure for inflation. So still not out of the woods when it comes to comparisons with the rest of the world. And the UK also has these specific problems with Brexit, and that is inflationary, and that's increasing the cost of food imports, for example. It's also restricted the pool of labour, which means wage inflation is pushed upwards in particular sectors. So that is a worry. But it does seem to be converging with the rest of the developed markets, albeit slowly. What's interesting is if you look at the wage growth for the UK, that's been surprisingly high, which is good in a way because obviously we want real wage growth. But as the Bank of England says in its latest monetary policy comments that went with this announcement, measures of wage growth and services inflation had remained at rates above those consistent with meeting the 2% target sustainably in the medium term. So that's the problem, right? We've got wage growth, which is good, but it's bad because it's going to push up service costs because it's going to be passed through to you as a consumer. And ultimately, the UK economy is very much driven by consumer spending, as is the US. So if we look at nominal pay growth, this is not inflation adjusted. When it's positive year on year, it's red here. When it's negative year on year, it's blue. And I've also overlaid the rate of CPI inflation. So inflation fell to 6.7% in the latest print, and you can see that total pay growth is 8.1%. So it has fallen from its peak, but it's still soaring upwards. But it is positive in real terms, which is good news for individuals, but not so good from the Bank of England's point of view. To see what would be consistent with 2% inflation, just look back before the pandemic, where the typical rate of wage growth was around something like 3%, often as low as 2%, but 3% nominal growth. So to get back there, how are we going to reduce wages? Well, obviously people don't want that to happen. The Bank of England actually came out and said you're going to have to accept that you're poorer. But the ugly truth is that if you want services inflation to fall, wage growth is going to have to slow down. If we do adjust it for inflation, this is real UK pay growth. Have you given up, Ted? Go on, you can have one more treat. There you go. I'll put it on the floor. If we look at real pay growth, this is inflation adjusted. You can see it's gone into positive territory. So good news for individuals, bad news for the Bank of England. And also, if we look at it compared to history, what's particularly painful is that if you look at UK average weekly earnings, when you adjust for inflation, they're back to where they were pretty much over a decade ago. We haven't really had an improvement in weekly wages in the UK for a decade. And it just looked like things were about to get better. And then we got the pandemic, fall, surge, and fall again. So it has gone very volatile, I think, that wage growth number. But that's one of the problems. We haven't seen wage growth, real wage growth in the UK for a long time, which makes it particularly painful when the Bank of England does say we have to accept we're poorer. But this is the problem. You know, you can't have inflation at a reasonable rate without having reasonable wage growth. So now let's take a quick look at the services price inflation, because that's really important for the UK, as I said, and according to the latest statement from the Bank of England, that's projected to remain elevated in the near term. The last time they made a statement, that was surprising on the upside, so the language has been toned down, but it's still uncomfortably high. So let's look at those two components of inflation. One of them is for services, the other one is for goods. So that's the kind of stuff that you buy. Services would be things like haircuts, lawyers, or a power hour with me. Although that hasn't gone up, I have to say, in year-on-year terms for a long time. We haven't raised our rates for a while. But if you look at the services inflation, that's just under 7%. And that's the yellow line. And you can see how that really hasn't moderated much at all. It has fallen slightly, but it hasn't fallen as sharply as goods inflation. So initially, after the pandemic, people were buying stuff, they were redecorating their houses, buying sofas, durable goods, because you were stuck at home. So you wanted to make your living space nicer, presumably. But that has now moderated and the supply chains have eased, so those goods can be supplied and the demand for them is lower. So goods prices are falling, but services, which are driven by wages, services inflation is still very high. And in order for that to abate, maybe we'll need a recession, maybe we'll need higher unemployment. We certainly need a labour market which isn't so strong, which is looking more likely now. So let's come on to that. Let's come on to the tight labour market. What does a tight labour market mean? Well, roughly what it means is that it's easy to find a job and it's easy to negotiate a wage increase. So if lots of people are employed, then it's pretty hard to find a new person to replace an existing person, so they've got a much stronger negotiating position when it comes to wages. And certainly by historic standards, unemployment has ticked upwards, but it's still low by historic standards. So, you know, roughly where it was in the mid-70s. That's how long ago you'd have to go to get such a low unemployment rate. Of course, it's roughly where it was just before the pandemic, which was also very low. So it is ticking upwards. So there is some loosening of the labour market, but not huge so far. And if you look at the other measure which the Bank of England uses, the Fed uses this as well, which is the number of vacancies, job vacancies, per person who's unemployed. For the US, that was really high. It was about 2 job vacancies per unemployed person. In the UK, it reached about 1, just over 1 job per unemployed person, but that has started to fall quite significantly. So there is a very clear loosening of the labour market in the UK, and that's reassuring from the Bank of England's point of view, because that's what they're trying to engineer, a looser labour market. Now, what's interesting is if you look at the number of employee jobs which are posted in the UK, and this is data up to June of this year, the number of jobs which are actually advertised and available and filled is surging upwards. Whereas if you look at the number of economically active people, that seems to have kind of stagnated. And the number of people who are employed also seems to have stagnated. So I think this is a problem with labour supply. An economist would call this a structural problem. If you're trying to find people to fill the roles, you just can't find them. That's the problem. It's matching people to jobs. So this also may explain why there are jobs available but not being filled. So, maybe there's a structural problem with the labour market. There was also a problem with people staying sick after the pandemic and lots of people retiring and not re-entering the workforce. That has eased somewhat. The participation rate has increased a bit, but still not enough to really ease the tightness of the labour market. So that's the problem. So what are the consequences of all this stuff, right? So what's the upshot for us as investors? This is what we care about. Well, we can look at, I mentioned the sigh of relief from estate agents when they said that the Bank of England saw that the Bank of England wouldn't raise rates. They'd kept it at 5.25. If you look at the mortgage rate in the UK, and this is for a 2-year fixed mortgage, and I'm varying the loan to value here from between 60% to 95%. So if you borrow 95% of the value of your house, you're going to pay about 6.9%. Compare that with where we were in 2021, and it was something like 2, maybe 3%. So that's more than doubled. So it's still the case that the housing market is going to be negatively impacted for some time to come, because the Bank of England isn't going to just cut rates now. They'll keep it at a high level for some time because they want to be absolutely sure that inflation won't surge upwards again. Because if it does, then they'd have to raise rates again and the economic uncertainty would just be terrible. So they'll probably keep it at this high level for some time now. It's simply a question of whether they're going to increase it slightly from where we are now. But it's not a question of them cutting aggressively. That's not going to happen. But certainly the pain is still there, and there'll be more pain to come as people roll out of their fixed period and they have to absorb these higher interest costs for their mortgages. Now, if you look at Berkeley Group and Barratt Developments, these are 2 UK house builders. When we got those numbers from the Bank of England, the fact that it was holding rates fixed, you can see what happened to their share prices. They surged upwards, these 2 big house builders. But then, of course, this is the UK. They gave up the gains pretty quickly. And by the end of the day, they're pretty much where they started. But you can see that house builders are one very rate sensitive part of the market. And they kind of cheered the good news. So what I would expect is that once the Bank of England does start to cut interest rates, it'll be good news for these house builders, as long as economic activity's kind of okay at that point. Another interesting thing was what happened to sterling. So sterling weakened on the news because lower rates means weaker currency, and the news about growth as well, which was that UK growth was expected to be weak, would also drag on the value of currency. But again, it fell and then rose again. So no huge move over the course of the day. What is interesting is if you look at the swaps market, and this is from the FT, the data I couldn't get, unfortunately, Ed Conway, what they did say was that the swaps market is still implying a roughly 70% chance of a final quarter point rise. So that's a 0.25% increase. So that'll take us to 5.5%. And that's going to be before March next year. So certainly the market doesn't think that we're out of the woods yet, and that we're not quite at the end of the rate hiking cycle. We've got another 25 basis points to go. And also, if you look at the FOMC yesterday, half of the FOMC members, I think it was actually 6 or 7 of them out of 19, thought that rates wouldn't have another rise, and about 13 of them thought that there would be another rate rise. I think that was the way it was. But it was kind of split whether there would be another rate rise before the end of the year. And markets in the UK, you can see, similarly think that there could be another rate rise. The other thing which I think is really interesting, and I did make this video about oil recently, it is ticking upwards. So if you look at the price of oil right now, due to these supply cuts, you can see that it's kind of flirting with 100. This is Brent crude, by the way. So it fell as low as just around $75 a barrel. But now it's looking like $100 a barrel, which is where Saudi Arabia wants it to be, is looking quite plausible. Now, if this happens, and if it goes further, it often overshoots, then we are potentially looking at a secondary inflation spike. And if that stays elevated for a long period of time, it could feed through into transportation costs. Food production, for example, is very energy intensive, so it would affect food prices. Restaurants have to heat themselves over winter, and they require energy to cook food. So again, they'd have to pay higher prices. So a lot of stuff is affected by higher energy costs. So this might be a kind of replay, a mini replay of the first surge in inflation which we saw previously. And it is often the case, it happened in the 70s, that you do get two spikes in inflation. Not a lot that the Bank of England can do about this, because of course they don't monetary policy doesn't affect the price of oil, but it could be another problem for them if it creates another sustained rise in inflation. So anyway, that's it. That's all I have to say. And now we'll turn to questions, and I shall summon my cockapoo, Teddy. He's already had some treats. I don't know if he'll come upstairs. But if you do want to ask a question, please do. And let me just see if we've got a question already. We haven't. So yeah. So if you do a super chat, obviously we'll push your question to the front of the queue. If you're one of our supporters on YouTube, again, we'll push your question to the front of the queue. And yeah. So please do ask a question. Oh, is Teddy coming? He won't come upstairs. See, Laura's got the good stuff. She's got the biltong. And if it's a choice between biltong and these healthy snacks, low fat, he's not interested in the low fat ones. That dog. So that's kind of snack inflation, isn't it? So good evening, McCready747. Nice to see you again. Here's a question. Is that the end of the interest rate hikes? We kind of answered that. I think personally that we probably will have another one, simply because core inflation hasn't really come down much, and that's what the Bank of England cares about. So personally, I think we could have another 25 basis points, 0.25% increase to 5.5. But yeah, we're close to the end of the cycle, I'd say, unless this energy spike comes to pass and it stays there for some period of time. Because, you know, for a short period of time, year on year, what we saw was that energy was pulling down headline inflation. Now we're seeing it tick back up. And like I say, for the US, that pushed up the latest inflation print. Instead of falling, it rose. For the UK, it just reduced the disinflation. But yeah, I think we might not be at the end of the cycle. What have we got? Any other questions? Inflation higher for longer. This is generic penguin. Yeah, possibly. And generic penguin also thinks they'll have to raise again next time around. Robert says it's that because of Brexit. Yeah, so I certainly think that Brexit is inflationary. Oh, you finally come, Ted. Finally. Oh, yes. Oh, he does like those. You saw me loading up the box, didn't you? Is that good? Yes. Yes. Oh, here we go. Here's a question which isn't to do with the Bank of England, but which is interesting. So please do like and share if you are watching the stream. I'd appreciate it. It's easy for you to do, and it helps us. The algorithm likes it. Please do like. What else, Ted? What's your honest opinion on financial advisors for people unwilling to learn about how to invest, plan, etc.? Well, I think of financial advisors are really important for many people. If you need to tax plan, you have a complex tax position, maybe you've got a company, you live in more than one country, well, in that case, your taxes can be very complex. So having tax advice from a financial advisor can be very helpful. Also, if you've got some kind of inheritance that you're planning with your family, they can be extremely useful for that. They can find very tax efficient ways to plan, your kind of family inheritance. So that could certainly be helpful. When it comes to things like asset allocation, which funds to choose, they're notoriously not helpful. You can learn yourself to do pretty much what you need to do in order to achieve your financial goals. Some are good at that, but I'd say very few. And usually you can learn yourself more easily. And I think if you do understand asset allocation and investment, then you're less likely to be led astray by your advisor, and you'll understand what they tell you they think you should do. So understanding, I think, is really important. So you don't get the wrong advice, so you'll know whether it's appropriate or not. But also, if you want to do it yourself, and many people do this, they go to an advisor who sets up their portfolio and their retirement system, explains it to them, and then they just go off and do it themselves. And this is my issue with financial advice, the way it's paid for in the UK. You have to pay a percentage of your wealth forever, even in years where they're not going to give you a lot of value add. So, having 1% taken out of your wealth every year forever is the wrong way to pay for it. I think a fixed fee financial advice model would be better, but that's just not something we've got in the UK. But they have huge regulatory costs. They have to have insurance in case people sue them for bad advice. So it's not easy being a financial advisor, but you do have some real... I've heard some awful stories, which obviously I can't share, but some people have had some really bad experiences that I've spoken to. Crude going high to 150, according to Borat. Strategic reserves from the US is bone dry. True, they're certainly depleted. Crude going high means there's still demand, so economy's still hot. Feedback into wages, more inflation. Yeah, I mean that's a fair assumption. Yeah. Scott Monday, did the Saudis open the taps little once they achieve $100 oil? Probably not, because they'll want to keep it high. I doubt they've increased production a lot. Maybe if it overshot 100, but they want to keep it at 100. So, if it went to 110, maybe they'd increase supply. But I don't think they're going to do it until we get there. And we're still not quite at 100. We're kind of flirting with $90. What's the latest price? It was 94, roughly. So we're still $6 short of 100. Let's see if we've got any other questions from Super Chats. Still no Super Chats. Interesting. Please do Super Chat because, obviously it helps us financially. And Teddy gets treats. Low-fat treats. Great. McCready747 says, go Teddy. And also that they were looking forward to 10% savings rates. Okay. Chris King says, I noticed the pound is falling. How far do you think it will fall? Dominic Frisbee reckons we'll be back to one to one next year. Yeah, look, I mean, currency, almost impossible to forecast. I wouldn't even try. You can use things like the purchasing power parity models, and they put it at 144. So, sterling's too weak, in other words. So parity, I think, is way off if you look at PPP models. But are we going to get there? The problem with PPP models is they can take a long time for currencies to move to the PPP forecast, and sometimes it never does. So can you forecast currency? Not really. With equity, with stock returns, you can do a reasonable job of forecasting over the long term, because they're mean reverting, and they have grown above inflation at something like 6% over the last century. So you can make forecasts long term, but over the short term, 10 years or less, stocks are very unpredictable too. And currency, because it doesn't drift, is much more difficult to forecast. Okay, we've got any other questions? Question from Ben Humphreys, who says, is it wise to lock into a 5-year deal mortgage at 4.8%, which is slightly cheaper than the 2-year at 5.25? Well, if we knew what rates were going to be, that would be handy, wouldn't it? But look, a rate's going to come down. I think they probably will once inflation is under control. The Bank of England's not... it's taking longer than the Bank of England thought it would for inflation to come down, despite their very restrictive monetary policy. So how long are you going to have to wait for rates to come down? And how much are they going to come down? I think it's much more likely they'll go back to around 3% rather than 0, which is where the interest rates were for a long period of time, or pretty close to it. So I think now we're probably going to see another surge in inflation due to higher energy costs, mini surge. That'll keep monetary policy tight for some period of time. So, but is it worth fixing? Difficult to say. Difficult to say. I wouldn't like to make a forecast about that. But if you've got a choice between 5-year fix and 2-year fix, the penalty period is really important as well, because if you can pay it off with no problem, without any kind of penalty, then who cares? You can easily switch to another product. You have to pay for the new product, I guess, but it could be worth it, and it could pay for itself very quickly if rates do fall. But if you're paying, we saw some cases where it was a 2-year fix was something like above 7% for a very high loan to value. There you probably would want to consider locking in at a lower rate. It may be worth waiting if you have the choice. Vanguard Gilt Fund, inflation linked or long duration or neither? Okay. Oh, we've got a super chat from McCready who says, sorry, my head is mashed. Keep up the good work. Sorry to hear about your head. Is it that rum? Was that you on Twitter talking about rum? Black rum? I've never heard of it. I had to Google it. Yeah, so the ficus is looking very well according to Lynn. Yeah, thank you for that. I've had some plant tips from Laura. Apparently they need light and water. Who knew? Anyway, it seems to be surviving for now, although I have seen spider mites on it, so it might be on the way out, and leaf insects. Amclusent says, glad that cough has cleared up. Do you know the cough was actually caused by Fanta? So I've switched to Coca-Cola, which doesn't seem to hurt as much when I choke on it, but literally a minute before I did the YouTube live last night, swigged my Fanta, started choking, and I choked for the first 10 minutes. Some people were sympathetic, some people were angry, it's got to be said. But thank you. Amclusent. Financial advisor horror stories would make a good podcast. That would make a good podcast. I guess if it's anonymous, then yeah, you can do that. Brilliant. Wouldn't the bank? Here we go. Dark trade. Wouldn't the Bank of England look foolish if it raised at the next meeting? Surely must wait a little longer. I don't think they'd look foolish. I mean, the reason why is they always say that they're data dependent. If they see a substantial sign of inflation staying high, then tighter monetary policy would be quite reasonable. So they do change according to what they see in the data. They have to, they don't have a choice. It's not about opinion, it's about what they see. And I think one thing that's pretty clear is that central banks are relying less on forecasts and more on data that's concrete, which they can measure immediately. Because the forecasts weren't very good, let's be honest. So they are data dependent, and they will do whatever's required, and that's absolutely necessary. I think that's probably a healthy move. They've admitted they're not good at forecasting inflation, and they just become more data dependent, which is not a bad thing. Taheres Fandiari, who says, you continue to do a great job. Thanks for all you do. Thank you, Taher. Fanta lawyers will be calling to have a chat soon. That's dark trading. You've got to be careful what you say, haven't you? But there was... Are there any super chats? Yeah, just the one from Creedy. Question from Nick Lloyd. Joining a little late here, so sorry if you covered it. Do you think this pause will soften the drop in the housing market? Sellers will maintain their stubbornness. I don't think so, because remember what's happening here. The central bank is just holding at its current rate. The reason for that, kind of like the Fed, is that they've already aggressively tightened, so they're just waiting to see what happens in the data, with the hope being that because growth is weakened in the UK, you can see that in their statement today, they're worried that they're going to stifle growth further by raising interest rates further, because that's what you have to avoid, of course, is a hard landing. The Fed's pulled it off better than the UK. Growth here is weaker, and so the risk of over-tightening seems to be greater in the UK, but inflation's also higher here and more stubborn. So will this pause soften the drop in the housing market? I don't think so, because it's going to stay high. All it means is they're not going to raise rates further. So personally, I don't think it's going to make a huge difference. Not until we see that core inflation number come down. When that starts, yeah, then it's kind of good news for everybody, because at that point, the central bank can start to think about lowering rates. Won't do it immediately. It'll wait until the data is confirmed, but there's a possibility of lowering rates at that point, and that's going to be good news for all those rate-sensitive sectors like house builders, realtors, or estate agents as they're called here, and of course for the housing market itself. But I think there's more pain to come before we get there. And the Bank of England said this themselves. There's more pain to come. Dark Trade said it's about opinion on the data. That's certainly true. They have an opinion on the data. They have to. But, you know, there aren't many steps of logic, put it that way, between what they observe and their monetary policy. Their reaction function is pretty simplistic. Inflation too high, raise rates. Inflation too low, cut rates. You know, it really isn't that complex. So Nick Lloyd said, thanks for the answer. We'll keep an eye on core inflation. Could be some time therefore. Yeah, I think so. So should we call it a day there? So I think we've kind of come to an end. So thank you all for joining us. I hope it was helpful. I hope it gave you a bit more colour on what the Bank of England did. And I hope Teddy enjoyed his treats, his low... Oh, he's back again. You know your name, don't you? Come on then. One more. And then we'll finish. You don't want it. Do you want it? You're wagging your tail. You don't want it. He just wants me to come downstairs. Go on, you can have it. So thank you all for joining us. I hope it was helpful. And remember, do like and subscribe. And you can do a power hour with me, one-to-one, if you want to discuss your investments. And do look out for our content on YouTube. And we do these YouTube lives whenever there's a monetary policy thing. So tell us if you enjoy them, because, you know, I kind of enjoy doing them. So that's good. I hope you do too. Anyway, take care everyone, and good luck with your portfolios, and see you soon.